This is Cece. Welcome to the Orbit. It is Tuesday, May 14th. We've got stocks unchanged once again today. This is going back to last week. You can see this effect of a lot of gamma in the market. We are basically sideways for the last couple of days, going all the way back to Friday. And then it was kind of that slow grind higher into this level right above the 5,200 level. We've been going sideways. Of course, the market is also waiting on tomorrow's CPI. We had a slightly hotter than expected PPI this morning. Market sort of shrugged that off. We had Powell speaking today, which the market was also looking ahead towards. The market is basically not a ton of headlines out of the Powell speech. So everybody's got their eyes on CPI tomorrow. And volatility is picking up into that CPI. You can see the IV at about 20. That expected move is just shy of 0.9% move at the close today, probably of at least 0.7%. Maybe if we go dead sideways the rest of the day, maybe it's a little bit below that, but it will be more than a standard 0 DTE expected move, which lately has been 0.4% and lower. So expect that vol to continue to creep higher, to hold that expected move somewhere around that 0.6, 0.7. After that, we drop off pretty quickly. Going to the 1 month chart, options are not pricing any particular fireworks out for the next couple of weeks, 11 and 12 IV. Let's go out to the end of the week and let's look at this setup, and let's do an iron condor right here. And we are going to choose the 17th right here. So the iron condor levels currently at about 52.75 to the upside and 51.70 on the put side. So we're about just over 50 points in either direction out to the end of the week. That is an expected move of just over 1%. Now, vol is low. Gamma is heavy in the market. That's why we're going sideways. Rallies are finding sellers in stocks. Sell-offs are finding buyers, and a lot of that is the gamma in the market. Market makers are staying delta neutral, so they have stock to buy as it goes lower. They have stock to sell as it goes higher. So that's the setup. Taking that trade out a little bit, we've got, getting down. Let's take this down to about the 4-to-1 risk ratio, and we'll see where we stand. Getting up to 110 here, risking 390. We are 53.10 to the upside, 51.35. So that is, positioning for the CPI, even for some movement with the CPI, but then an assumption that we don't make a massive run into expiration Friday. And remember, if the market is loaded with gamma beyond CPI, it gets even heavier going into Friday's expiry. So if we find ourselves somewhere near this 5,200 level, we're even at 5,250. There's a lot of gamma up there, a big call wall, or down below 5,200. You might see that gamma accelerate and the effects of that gamma accelerate and sort of stick the market in the mud. Now, what could break us free of gamma, and where could the next volatility come from? Well, you're probably aware we're in a meme stock era too. So let's go to the tape, and we are looking at GME at 50, and you can see what that's done the last couple of days. If you weren't around for the last meme stock era, if you've forgotten some of the intricacies of what goes on in these short squeezes, it's very different than traditional options trading. So the first thing to go over with a stock like GME is, as the stock goes up, volatility will explode. We are looking at 700 IV into Friday, pricing about a 45% expected move, call it 50%. So options are pricing for GME to have another 50% move from here, up or down, into Friday. Going out next week, 510 vol, 420 vol, 3 weeks out. So you can see volatility is sky high. The higher these stocks go and the higher they squeeze, the higher that vol goes, which is usually the opposite of how a traditional stock behaves, because stocks usually crash lower and grind higher. In the case of meme stocks, they behave much more like a commodity, oil. The other thing to remember is there could be massive skew here. So if you are trading one of these things, and let's say you are picking a top at some point, and who knows where that could be. This could go on for days, and these things could keep squeezing higher. They're completely detached from any sort of fundamentals in reality, obviously. But so they're basically a video game at this point. But if you're looking for opportunity as an options trader, that can be something completely different. Because one of the factors of that is that these at the money straddles, and that's essentially what's producing these expected moves in the options market. We go out 3 months, AMC's straddle, you can see the expected move, takes you down to about 165 in the stock from nearly 8 today. And this is only out to July 19th. At some point when these stocks go higher and they suddenly become, in this case, 250 IV out there, when they start coming back down, the straddle can only price to 0. It can't really go much beyond that except for some weird put call skew in the same line. But think of this as an at the money straddle that with the stock at $7.77 can't really get above $7.77 because that would be an inefficiency in the options market where you could sell that straddle and know that you can't lose below 0, and then you could position to the upside to protect that kind of trade. If this straddle was 15 at 800 volatility because AMC could go up $15, the at the money straddle can't really price that because it has 0 to the downside, if that makes sense. So there's all kinds of inefficiencies, and I think it's, even if you're trying to learn options, these are an interesting edge case because the math starts to break at certain points, and options market makers find it very difficult to kind of price this like a normal stock. So, in this case, on these kinds of stocks, let's say AMC went to 20 and then you wanted to position for it to come back to 10. A lot of times there's out of the money butterflies that get really interesting. So this is a cool couple of days to play around on the app and move these, move some of these trades around. Even taking this, if you move this butterfly lower and you get the bottom strikes down near, so you can start to position, perhaps like instead of looking for a call or a put to position directionally, or even a call spread or a put spread, look at butterflies, look at condors and move them directionally in one direction or the other. And you might find that you can create a really big profit zone. So in this case, it's creating a profit zone, this butterfly, out to Friday, where it makes money if AMC finishes anywhere between 715 and 385. And not that that's necessarily the right trade or anything, but it's kind of interesting to play around and play around with trades that you might not have considered for your views in a stock like this.